Hello, everyone. This is Liz Faircloth, co-founder of InvestHer. Excited to have all of you on for our first webinar of 2025. I cannot believe we are here in 2025, Brenda. I'm going to just keep an eye out for your co-presenter, Melissa, as we get going. So I know folks are joining. I'd love to hear from you in the chat box, where you're calling from, what you're excited about learning. We are appreciative of your time. And it's what we really stand for at InvestHer, right? Supporting women, empowering them to live financially free lives and doing it in a way that works for your life, right? That's what this is all about. And it begins with building a team, especially on the financing side. We can't buy real estate, grow our portfolio without financing, which where Brenda and Melissa and Conventus are coming in to talk a little bit about building a team, right? So thanks for being here, Brenda. I'm just going to keep an eye out for Melissa to jump on here in a moment. And then we'll get going. But I'd love to see in the chat box where you're calling in from. Also, when it comes to building a financing team, what do you want to get out of today's webinar? This is all about making sure you get your needs met. We, serve you in the best way possible. This is live. And so really love fielding questions and getting into your businesses and how we can best support you, especially in changing times, right? The need for financing and creatively is always, it's always important. So, all right. Hey, Robin from Houston, nice to have you here. And if you're new to our community, if you're new to, hey, Carissa, glad to have you here too. If you're new to our community or new to coming to our webinars, please put new in the chat box. But I'm going to keep an eye out for, yes, well, good to have you here, Robin. Glad to have you, and Happy New Year. Hey, Belinda, good to see you here too. So I do not see, let me see here. Just keeping an eye on Melissa, just so you can get going here. And, but I do not see her. So, let me see here. I see
just sent her a link as well.
You did? Okay.
Yeah.
All right, cool. But why don't, I don't see Happy New Year. Okay. Any other, as you're joining, please just share in the chat box where you're calling from, and something when it comes to building teams around financing, something you want to learn, some of their frustrations. What do you want to get out of this webinar? The more intentional we are with anything we do, especially as we kick off 2025, the more we're going to get from what we're doing, right? Versus just showing up and hopefully we'll get something out of this. No, come in with an intention, come with a focus, because we want to best serve you as we kick the year off, and we certainly kick off this topic of building teams. All right, why don't you begin, Brenda's, because I want to make sure we're on time, and it's almost 4 minutes after. So if you want to get going, introduce yourself and everything, and then we can get going. But just a quick intro for Brenda and Melissa from Conventus. When Melissa joins, they have been a partner and a sponsor of ours for many years. They work with many women in InvestHer. They're based in California. I know Brenda is involved with one of our chapters. Same with Melissa. So these two women are very involved in our community, not just from a lending side, but from a community side. And so I just want to mention that. Really appreciate all of your support over the years, and excited to have you back at InvestorCon in June 1st to 3rd. If you are not coming, you have to be there in Orlando. It's going to be great. We're gearing up, 6 months, almost 6 months away, just less than 6 months. So, but thank you everyone for being here. Why don't you kick things off, Brenda, and then we'll go from there, and fielding questions and supporting everyone on the call.
Sounds good. Thanks so much, Liz. Super appreciate your community, being a part of InvestHer over many years. And so today we're going to talk about building your financial team, financing team, and maximizing profits and scaling your investments. So I'll go through a little bit of my story. So I started out in around 2017. I'm based in San Francisco, and I'm currently the managing director at Conventus Lending. And we've been involved in thousands of transactions over the past 7 years. And in 2018, I founded the SF Bay Real Estate Club, and I also founded an investment a company called Venus Ventures. So I also do some development in California, and I'm super committed to empowering women. So that's why I founded Venus Rising, which is a personal development community bringing women together to learn like this. And I've been hosting events for the Invest Her Bay Area chapter as well. And so at Conventus, we funded over $7 billion, and it was founded 9 years ago. We're also based in San Francisco, but we're nationwide. I think I see Tam on here as well. She is also one of our team members. And so customer service is one of our core values. We're coming to financing from an investment perspective as well. We know what it's like to be a developer and how difficult it can be. So we want to make financing something that it's easy for people, not, something that people have to jump through a lot of hoops and difficulty to get. And so, let me see if Melissa is on here yet.
Yeah, I'm trying to troubleshoot behind the scenes here. So you,
Okay, so I can go through some of her slides. So a few options for financing. You have a lot. You can go through conventional lenders, you can go through private lender or institutional private lender like Conventus, or you can use cash, of course. And so hard money, it's called hard money because it's based on the hard asset. And so there are a couple options that we'll talk about with hard money, which is bridge loans, construction loans, and DSCR loans, which we'll go over later here. And so we do a lot of bridge loans. What are bridge loans? They're shorter term loans, and people use that a lot for fix and flip. They go through renovations, or they are adding a lot of value. Oh, I see Melissa on
I
here.
am so sorry. I don't want to interrupt because I don't know where we're at, but like I was watching and I don't know. I'm so sorry. I'll let Brenda finish and then.
Oh,
no worries. Good
no,
to see
all
you.
good.
Good to have you, Melissa. Nice to see you. Happy New Year. It's all
Happy
good.
New Year.
It's all
Sorry,
good.
Brenda. I was like
all
watching
good,
you and
all
I'm like,
good.
what's happening? But yeah, did you finish the slide or no?
We can just go back to your intro.
Oh,
Yeah.
okay. So you did your intro already?
Yeah.
Okay, cool. So I'm on the other side of it. I'm based out of Seattle and I've spent my dogs, gosh, this is not ideal. Can you hear the dogs in the background? Are we doing okay? Okay.
You're good. Yeah.
Perfect. So I'm based out of Seattle and I started doing lending about 3 years ago. But prior to that, as a professional, I did fix and flips on the side. And sorry, okay. I do fix and flips on the side. And then when COVID hit, I swapped over to just doing lending altogether. I don't really do flips anymore just because I do so many flips with my clients that I guess just get to enjoy the process with them. But I still have my long terms and I still do passive investing. I lead the Seattle chapter here, and we're a smaller group, but we're growing and we're really excited for all the new rollouts and the app and everything that's happening. And then I do lots of outreach just to help continue to empower women in this space to be confident in what they're doing. I actually started as Brenda's assistant. So it's really fun for me to get to do presentations with her because she's basically taught and instilled a lot in me of how to succeed in this industry and really how to connect and help women grow. So this is kind of like a fun thing for me to be able to do. But yeah, so that's kind of a little bit about me. And then I'm sure she went on about Conventus, right?
Yeah.
Cool. Okay.
So we can continue on here. Thanks so much, Melissa. So bridge loans are shorter terms, typically around 12 months, but you can negotiate for a longer term. And sometimes people use it for ground up. We can even refinance mid-construction loans. Sometimes it takes time to get permits and things like that. So we'll go through specific examples on what people have used bridge loans for as well. And there's rate term refinance, which means you're only refinancing the existing balance of the loan. And then there's cash out refinance, which means not only are you refinancing the existing loan, or it's a free and clear property, you're getting additional cash out. And so sometimes bridge loans, they have a few requirements, or they are able to get you more cash out. And so that's why people would prefer bridge loans as one of their options. And so why do people use bridge loans? Typically it's for the speed. So in at least in California, it can be very competitive to get properties under contract. And so sometimes we can close in as few as 7 days. And so they're able to get the property under contract and then refinance or do the project and then sell quickly. So this is typically for a quicker turnaround. And there's also another type called delayed purchase. So sometimes, if the investor is even, in a bigger rush, then they can even do a cash purchase and then get their cash out right away. So it's kind of like a purchase loan, but they're actually using their cash first. And typically, depending on the lender, it could be like 3 months or 6 months to qualify as a delayed purchase loan. So feel free to ask us any questions about that afterwards. And so typical pricing on this is definitely the monthly interest rate. You want to know how much it is, if it's amortized or not. Typically, bridge loans are not amortized, which means that you're not paying down the principal, you're just paying the interest. And then the origination fee, processing fee. If you're doing construction loan, there's the renovation setup fee or the draw fees. And then definitely pay attention to other fees that might come up, like any legal fees. In certain states, you might need to pay a legal fee. Sometimes they'll need to review your entity. Typically the lender might be the ones paying for that, but you just want to make sure who's paying for what. Appraisal fees, which reports they're getting, and we'll talk about ways to save costs on that as well. And then typical terms are around 80 to 90% of cost for a single family, 1 to 4 units. So above that, 5 and up, it would be more like a commercial property. And so for that, it's typically around 5% discount on the LTV and up to 100% of the renovation or construction budget, around 70 to 75% of the loan to ARV. So that's a very important metric to look at. And so, around 9% to 10.5% typically, but of course, always talk to your lender and your experience is going to be key in this. And then typical terms, again, around 12 months, no prepayment penalty. And we'll talk a little bit about that as well. So how to optimize your costs. You want to optimize your interest payments to see which rate you can get. And then also the points. So in order to see what costs, how to save money on your costs is how long is your project going to take? If it's a longer project, then you might want to have a lower rate, but pay more upfront. So definitely calculate how many months is it going to take, so you can see, which to optimize for, whether it's the interest or the origination fee. Processing fee, that's typical, that can be negotiable. And so definitely look at each line item to see what you can save your costs on, and then can the lenders split the reports with you? Typically, if it's a refinance, lenders are much more willing to split some of these costs with you, or to even do no points for refinances. So that's a way to save as well if you're using the same lender for your refinances. Insurance, right now, insurance is a big deal. Right now, especially as you see like the fires happening and all of that, definitely shop around for insurance to see, what your lender's requirements are and also which insurance agents can provide that. Your lender will typically have a lot of people that they can tap for insurance quotes. And not only that, if you are wanting to close a deal quickly, then you want to make sure your insurance agent can turn around those quotes quickly. And then, ask about referral fees or any exceptions. And then these are just topics for you to ask your lenders about because we don't have a lot of time here, but you can also ask about minimum interest period. So some lenders will give you a lower interest rate if you're able to take on a minimum interest period. So for example, if you're able to hold the loan for, let's say, 3 to 6 months, you can ask for a lower interest, interest rate, so that they know that you're going to hold the loan for a certain amount of time. And so not every lender is going to do this, but it's a possibility. So definitely ask about whether if you take on a minimum interest period, they could lower your rate. And then also, depending on your lender, asking for a shorter term could also lower your rate. So if you only need a loan for, let's say, 1 to 3 months, you could see if that can lower your payments or your origination fee. It depends on the deal. It's very deal specific, but it's something to ask your lender about. And then so we want to share with you real examples. So these are some of our numbers from our clients. So these are some of the costs that go into a project, development project like a flip. And so, of course, you see the hard money interest, you see the inspection fees, insurance fees, materials, permit fees, property taxes, down payment, all of that, staging utilities. So definitely go through each line item to see what you can save. And so financing is a huge part of it. So definitely make sure, you know, how much how much time your project is going to take and how many points you're going to have to pay, because that's a huge line item here. And then another thing is the down payment. So depending on your experience, you may be able to put down less for the down payment. So it's, again, another conversation to have with your lender, because that would mean less equity from you and potentially a higher profit for you as well. And then, so this is also another example. So this is one of our new borrowers. She had a mentor, and I want to highlight that because this is a pretty tough project to take on for a new investor. She had a really good FICO. She had good reserves. It's her first investment ever. And so it was in San Jose, purchase price around 1.03 in February. And then she actually had a higher valuation of her project at the purchase. So she got it at a good price because it got valued at 1.46 million. She estimated around 300,000 for the renovation. And for her scope, she was gonna turn this from an office building to a more of a configuration for a single family home to live in. So she changed it from a 2-bed, 2-bath to a 4-bed, 2-bath. And then she was able to get her permit approved and get San Jose to say, this is not an office anymore, it's a residential property. And so she estimated it, the ERV at 1.8 million, but it actually sold for 2.3 million in November 2024, which is around 9 to 10 month project. So this project actually took longer than she expected with the permits and everything. So another thing that you can ask your lender about is the term. So she could have asked us for a longer term when she did this loan, like, 18 months, just so she's not scrambling at the last minute to get an extension. And so she actually made 600,000 on this project, which is amazing for her, especially for her first project. So we just want to highlight a real example that happened recently. Turn it over to Melissa here.
I'll unmute. We're going through some high level things. Like, I know that this prompts so many questions. So again, at the end, you'll get to our info. And if you have questions, just reach out, because sometimes it's just easier to, because your questions are specific about your project. So it's easier to kind of like diligence them. So we're always going to be here for you guys. So don't feel like any rush or urgency right this moment. Lots of info. But going on to the other side of what we do best is our DSCR loans. These are great loans, but I wanted to highlight some of the things about how these are presented to you in the market. A lot of times that you'll see something, I get people that say, I saw 5% with some other lender, and I'm like, oh yeah, 5% is probably their floor. But what happens is there's always a base, and then there's all these additional add-ons. So I kind of listed these for y'all to see, because like we advertise 5.5 to I think 9% for our DSCR. And 5.5 is the best we can do, but that's like if every star aligns and every moon and it's perfect, and that's never going to happen. It's rare. So I would say the lowest DSCRs we do is maybe 5.75, but those are leverages that are not at 75% cash out. So when we say the floor is 5, for every one of these bullets, we're adding on more rate. So if the FICO is lower than 760, you're going to have an upcharge, more than one unit upcharge. If it's not a good population, upcharge. If it's not a 30-year upcharge, and so on and so on. So in reality, DSCR rates are more like 6.75, low 7s right now. And that's the average we're seeing for like cash out refis, rate term refis, and purchases a little bit lower. I've seen like 6.25 for purchases. So this more, I just want some disclosure, because DSCR is a great product. It's wonderful for investors, but a lot of times I get frustrated borrowers who are like, how can I get these low rates? This lender said this, and now they can't do that. And it's really because they're only advertising to get you in the door. So when you get in the door, ask these questions, give them all these details about your project so you know all the upcharges. And then to talk about DSCR just a little bit further, we're gonna if I get all this info, I'm gonna quote you at 1.2x if that's what it looks like. So your DSCR looks great. That's the best pricing. But I also like to give you a quote of what happens if that drops, because DSCR is not set. As much as we lock the rate, if your value comes in low or your market rents are low or your insurance is way higher than you thought, taxes for the next year are way higher, that DSCR is going to change. And so from the jump, ask your lender when you're vetting, what will happen if my DSCR drops below 1.2? Because then we can price you as well, because you kind of see like the next level. We offer 2 programs to handle different situations, like one's for vacancy properties, one's for rented properties, and then one's for like lower than 1x DSCR, which is honestly like rough pricing, but it works for like short-term rental. So there's just a lot to DSCR. So I don't want people to feel like they're getting bait and switched. It's just you're not getting enough information when you're being sold to get in the door. So I really want you guys to just have the what to ask for about DSCR. And then our standard leverages, we're pretty standard with across like DSCR lenders. We're 80% on purchases on rate terms. Cash out, we lower it down to 75%. I get a lot of requests for 85, and I get those people come back because they can't find it. I think there's like a couple people that do it, but it's super high rate and it's just not worth it. So like Brenda had talked about, is it sounds good until you run all the numbers and the holding costs. So just kind of look at both sides of that. Oops. Okay, so similar to
can I do
Oh,
one,
yeah.
say one quick thing, Melissa? I just want to encourage everyone to ask questions in the Q&A box. That way we can field as many questions as possible. That's why we do these webinars live, because you're working through deals. You have questions that are particular that, you know, are helpful to navigate, right? This is not a recorded webinar you're watching. So I just want to encourage everyone to ask the questions in the Q&A box. You know, you got 2 seasoned women here who are doing a lot of deals. They know what they're talking about. So this is a great opportunity to kind of pick their brains and everything. So please put it in the Q&A box if you can. So that's all I wanted to say.
Thanks, Liz. Okay, so similar to what Brenda showed about flips, typical cost for DSCR is the same. You're going to have that interest rate, but instead it's the full. So it's going to include the principal, interest, taxes, insurance, and association fees. Origination point, again, is here. Processing fee is here. These are all our fees as a lender. You're going to have your escrow and title fees. You're going to have an appraisal fee. All DSCRs need an appraisal. It's pretty standard across lenders, where like a bridge loan could maybe do a drive-by or a BPO. So it's a little less strict on the bridge side. Again, legal fees if your state requires it. But one of the big differences is DSCR requires reserves. It's like your personal home loan. You're gonna have a reserve account for your taxes and your insurance. We pay those in the loan, so we have to have that reserve account built up just in case a payment's missed or the first couple months where we're trying to catch up because you don't pay that first month. So a lot of times borrowers are shocked because they're like, I want to pay my insurance on my own, or I want to do this outside of it. But these DSCR loans are very, very much like a conventional loan you'd get like on a personal residence, but it's for a rental. And then typical, I just kind of put pricing. I think I did this slide maybe a month ago, and pricing has gone up a little bit since then. As much as, you know, things feel good, rates for DSCR has gone up slightly, but still really good right now. But typical pricing, around 6% for cash outs, but those are your DSCRs that are good at 1.2.
So building your financial team. So you definitely want to make sure you have a range of people doing a lot of different things to help you on your strategies. So conventional lenders, definitely see what options they have out there. A lot of them have very different programs, so it really depends on specifically what your strategy is. Private lenders who are, maybe individuals that can do some financing for you that have different programs. And institutional private lenders, that's a lender like Conventus that can help with shorter term financing. They have some requirements, but not as stringent as conventional lenders. So flips, ground up construction, refinances, transactional and DSCR, like what Melissa mentioned, and equity partners. So do you want them to come in on a specific deal, or do you want to come in on all the same asset types, or is it project specific, or is it a fund? So that's definitely for you to figure out, how much equity you need. And then on the debt side, who can help you out on your specific project. If you want takeout lenders, what are the rates? What are the requirements? You definitely definitely want to see what the takeout lenders are before you even start on a project and get in on a private loan like Conventus, because the rates are higher. So definitely see what your options are for the takeout as well and what the requirements are. And so here's another case study I wanted to share. So this is a bridge loan, transactional loan for a property in Georgia. So it was 267 units. And so why did they need a bridge loan? They need a bridge loan because they had a conventional loan that had requirements for them to fix up the property, but they already had a buyer identified. And so the value was there. The LTV was pretty low, around 56%. And they needed to just take out the conventional loan so that they didn't have to do those requirements and be in default, and so they could sell the property. And so we did refinance them really quickly, and so he was able to sell it to the buyer that he wanted to sell to without having to spend a bunch of money in improvements that he didn't need to make. So this is just one of the examples. So there are tons of examples out there. The reason people use private lenders is because of the flexibility. And so it's really identifying what your needs are and who can help you out. And so in terms of scaling, again, you want to figure out what is your strategy and can your financial team help you scale? So sometimes lenders are capped at a certain volume. You want to know upfront what that volume is, if there is a cap, and what is the total equity requirement from you. So sometimes not only is there an equity requirement, there's also a reserve requirement. So you want to know that before you get into a project. And another key thing, especially for conventional lenders, is the DTI. And so why do people use private lenders? It's because there's no DTI requirement, so you can scale. So a lot of our borrowers actually do qualify for conventional, and they're always trying to get conventional because they have the lowest rates. But sometimes they have requirements like DTI where they look at your debt to income ratio across all their properties. And even if that specific property, for example, does cash flow, if it doesn't, if they don't cash flow or the DTI is too low across all their properties, then it wouldn't qualify for conventional. So that's a way for them to keep buying properties and without having to be capped. And so another thing to think about is, can you realistically BRRRR? So what is BRRRR? It's buy, renovate, rent, refinance, repeat. And so before you get into a project, you want to see, again, who your takeout lender is, and are they able to achieve the LTV that you're looking for to get your cash out? And if not, how much do you have to leave in the deal? So if you can't get all your cash out, then you're not going to be able to use that to buy more deals. So that's definitely another thing to look at. So definitely find out what LTV your lenders can offer on the takeout side, and see, does a conventional loan make sense, or a DSCR loan, does that make more sense? And also, do you have a good system for deal flow? So what we're seeing out there now is it is quite competitive to get good deals. So if you want to scale, you want to make sure you have a good system to get consistent deal flow. So there's just a couple things to think about.
That's good. Okay, so we have 3 more slides and then we'll answer more questions, but I'm going to give you a lot of info because this is the question I get a lot from new borrowers or even borrowers that are looking to scale and like make it easier, is just how do I be a better borrower? Like, what are we looking for as a lender? And one of the best things is, you can imagine how many people email us and say, can you look at this? Can you look at this? Is to be organized. The more organized a deal is when I get it, the faster it gets looked at, the easier it gets priced. And then you now have your answer right away, and you can keep, diligencing and keep vetting other lenders. I think in this space, I'm all about competition. As an investor, Brenda and I both have been on that side of it, so we know what it feels like. And so I am more like, bring me another quote and I'll beat it. Like, I'm not shying away from any of that. I want you to go out there and look. I want you to see what's out there. And then if there's somebody beating us, bring it to us, because like, we're very competitive and we're really good customer service. So I'm sure we will be able to beat that. We find that's something that we strive to do. But also I look at other people.
It sounds like you have some fun with that, Melissa.
I do. Like,
I'll beat it.
I grew up very competitive in sports. So
sorry to interrupt you.
But I do find when I see other LOIs, I'm like, this looks great, but you're paying, interest on the undrawn, or look at your processing fee. It's 3 times ours, or you're paying 4 points versus our 1 point. And I don't win every deal, because sometimes I get an LOI, I'm like, dang, that's good. Like, go take that one and bring me your next one. But it's important to shop and kind of like look around, and but we definitely try to beat them. Brenda, could you go back up to that other slide real quick? The last one.
Is it this one?
No, the next one up. Nope, up, back. Sorry, go back. Yeah, this one.
Okay.
And then at the end of our slides, I have 3 that are just examples, and we can send this stuff to you, but it's just how to organize your deal. And they're bullet points, so that we'll be able to, you can take it anywhere. So if you fill out my bullets, send it to another lender, send it to another lender, and then you can get your apples to apples and see where we're at, and then bring it back to us and we'll win. But it's just a good way, be organized. And another way to be organized is to do a personal financial statement, because a lot of the stuff we want as a lender is your background. What do you owe? Where are you at? Because sometimes everything's great, and then I find out you have a FICO of 550, or the asset and the balances aren't right, or something. And so it's better to have that whole picture. And I do show an example at the end of an easy one. It's an Excel, but they're everywhere. If you find one on Google, it's just a personal financial statement, and it tracks your finances and it tracks your investments, and it shows us as a lender, one, I want to work with you because you're organized, and 2, it makes it clear for everyone. So that's another great way to stay organized on deals. The other thing is to know your exit plan and look at a few different ones. Brenda talked about this already, but I couldn't stress this enough. Not every exit plan is right when you get to the exit. Like sometimes this flip that you thought, you want out of is like, now it's going to be your next investment, long-term hold, or vice versa. So look at a few different exit plans for a deal to make sure that if A doesn't work, if you can't sell, the market dies, something happens, you can hold it, or like what would be sustainable for you to get through to the next season. A lot of times we get so emotional about the deal, the project, and then the exit plan. The only exit plan that will work is your whole life it's got to work. And that's not fun. It's too much stress. And that's not how investing should be. Like have some options, look at all of them, and then run those by us. Like talk to us about them, because I like to see that, like, okay, if they can't sell it, the market's like this, or something, it helps me know that you're investing in your own investments, and we're going to have a good outcome on this project because we're in it together. That's the big thing, is like, we don't just sell these and then we're done. Like, we're in this till you exit. If there's any issues with payments, you get a call from one of us. Like this is you and me to the end. So we want it to be a good partnership. Borrowing experience. This one always kind of trumps people. Okay. So we lend to no experience. So find out from your lenders if they'll lend to no experience. You get better rates at 3, 5, 10, 12. You can get more options for higher leverage the more experience you have, but we lend at 0. So it's still, you're not like a black sheep. Like, you got to start somewhere. You're not going to get 90 and 100 with no experience. But experience is on title. So if you've staged properties, if you were a consult on properties, if you helped decorate the property, if you gave them money for the property in a promissory note and you didn't go on title, it's not your experience. So I really stress to people, when you're doing these JVs, these partnerships, this passive stuff, decide, are you building your experience, or are you just building some funds in your pocket? Because if you want experience, you got to get on title somehow. And then FICO is power. Some of the best people in the world, we get stuck in loans because the FICO is too low, or there was a late on a mortgage payment. And it's so important, because we're not a bank. So we don't do the bank diligence. We don't have all your income. We don't do all that. We just need to know you pay your bills, and we trust that. So mortgage payments, car payments, those are majors. Like, don't make lates on those. Make those auto pays, make them consistent, because if you are consistent and there's no lates, you have good FICO, it opens every door for you. Once you start getting lates and having issues, it closes some doors, and it's just unfortunate, but it is what it is. You could have so much in assets and in equity, but if your FICO is not there, your currency with lenders is kind of damaged a little bit. So, and then the last one on this one is call these guys out. Anything that's non-standard, assignments, double closes, IRA funds, 1031s, we do these. Lenders do them. They're not like terrible. It's just they're a different route when we underwrite. And the worst thing, and it happens, and it's unfortunate, but we get to the almost clear to close and find out there's an assignment, or find out, oh, it's IRA funds, and it's handled so differently. So always call out the non-standard things, always talk about them, like really have a good relationship with the lender, be able to be honest and upfront, because that makes the deal flow easy. And all the hoops we have to get through, we can get through ahead of time in first underwriting and not at the end.
Awesome. And we got a bunch of questions here, but
Okay.
I want to make sure you get through this. This is really helpful stuff.
Okay, I'm gonna go fast. I talk too fast already, so I try to slow down, but then I have to speed up. So I'm going. Okay, so these are the need to know. I've compiled these 2 slides over the years of just the secrets I wish every borrower could know from the jump. So first one is, who are you working with? Are you a direct lender? And this is about vetting your lenders. So are you a direct lender, broker, third-party lender? This is a big deal. Direct lenders like us, and there's many of us direct lenders out there. It's our fund, it's our fees. Like, we waive some of the points because we value the relationship and want to build the customer service. Brokers are kind of a middleman. So they're charging our fees plus their fee to bring you to us. And so instead of that 1 point with us direct, now you're paying maybe 2 or 3, sometimes 4. I've seen some bad situations, but it's the brokers, there are some brokers that really do a good job. And if you need one, they're there for you. But everyone in these groups, I feel like, are doing so much to learn and educate. This is an area you can learn and educate on your own. Find good lenders, vet them, talk to people who've used other lenders, get experience from them. I don't think everyone needs a broker. I think there's some certain situations where they're very helpful. But I would always say find a direct lender. If not us, find somebody that you trust and can work with. And then there's third-party lenders who they say they're a lender, they're white labeling, they're out there advertising, they're on Facebook saying, I can help you, give you 100%, just sell me $1,500. And those I just completely like stay away from, because they're not even a licensed broker. They're just somebody who decided one day to start a company and kind of be the middleman. And you run into a lot of delays, fraud. You just don't know what you're getting. So focus on direct lenders, find them. If you really need a broker, like you work full time, you just need help, or financing is completely over your head, find a reliable broker. And yeah, so just know who you're working with. And then in-house processing, underwriting, and closing. It's important to know if your lender does it all in-house or if they outsource any of that. So like, we do it all here, and our teams follow through each process. Like, we're not the underwriters, but we're very involved. We're not the closers, but we're there. But I do know other lenders kind of outsource those, and then you get some disconnects and then timing gets off. Ask your borrower about repeat borrower benefits. The bottom line is it's easier to do a repeat borrower. I've already underwritten you. I already know your background. I don't have to spend all that time. So over time, the more you use us, you definitely get better rates. You get better leverages. There's less risk because we've seen you exit flips. It's the real thing. And that's why I always say find a good couple lenders to stick with and build that reputation and relationship with them. I think Brenda talked about lower rates and points. The lower the leverage, the lower the rate it's going to be. If you have a longer term loan or you need a longer term for a loan, you definitely want to have as low rate as you can, but you might pay more upfront. So it's a balancing act with how much you pay upfront with points or what you pay on your rate throughout the loan. And I get this question a lot, and I don't mind answering it, but find out how your loan officer gets paid. If they're motivated by the rate and the point, you might not be getting the best pricing out there. So at our shop, we don't make money off, like if I sell a loan at 12% versus 10%, I make the same commission off of it. So I'm not incentivized to like sell higher rated loans, where I do know some other shops are. And that's just unfortunate, but like that, everyone makes their money different ways. But just ask. Like, I was straight up asked one day, and I was like, why did you ask that? And she was just like, well, and explained why. I didn't really know that was a thing, but just ask, like, how do they make money? Are they incentivized off of a higher rate? Because you might not be getting the best options if that is true. Always understand with hard money, it's generally monthly interest only. We're not a balloon at the end. That's more of your private money stuff. I do get that question a lot. So just highlight it to know if you're paying monthly, so you have reserves for that, because you're going to have money in holding for those things. No one needs to pull your FICO to quote. You tell us what it is and we'll quote you. If you're off, your quote's going to be off. So you want to be as close as you can on that, but don't let people pull your FICO to quote you. It's not needed. Once you get into a loan and get in with a lender, then you want to then they're going to pull your FICO and they're going to do that, but that's because you're committing to them. But you don't need to do that to just get an application done. I see that happen with a lot of brokers too, because they just pull people's FICO, and you don't realize you agree to that when you enter that agreement. There are no upfront fees for quotes. You don't need to sell people money to get a quote. We're giving them out for free. Like, remember, we're competing. Like, I want your business, so I'm trying to get you a quote. So don't pay for it. So, okay, and then I had to add this because one of my former clients was like, but you made me pay an appraisal deposit once. And that's true. So when we do refis, they're full refis. And sometimes on multifamilies, those appraisals are like $5,500 on like commercial appraisals. So we will have you do a deposit for that, but it's like a link. It's directly to, it goes to our appraisal company. Like, we don't make money off of it. But yes, in those cases, there is a fee. I did have to disclose that one. Make sure you know if you're paying interest on the undrawn or not. So again, when I see LOIs and people are like, well, they quoted lower. And I'm like, yeah, that 8% because you're paying 8% on the 150,000 that they're holding for you. Where with us, you don't pay interest on your rehab holdback until you actually use it. So you save interest on that. So that isn't apples to apples. So always ask about that. And they call it non-Dutch and Dutch. Still, I Googled it once. I don't remember why, but it doesn't make sense. But that's kind of the term that they'll use in the lending world. And then always find out if your lender is BRRRR friendly. Brenda talked about this, and this is kind of one of the big things happening right now, which is a great plan. With us, we are BRRRR friendly, and other lenders are too. But always find out, because if you do a flip with us and say we charge you a point, when you are finished and you bring it to us to do your DSCR loan, we don't charge you a point again. So we kind of incentivize you to keep the loan with us. I mean, we still have good rates. Like, we're still competitive. It's not like we jack the rate up. It's still the same rate. It's just better. No point on the second one. Oh, wait. That's okay. I was like, I can't go that fast, Brenda. Okay, one more slide of me talking, and then we get questions. Sorry. Okay, so keep going to this. Is the second page? Okay. Oh, we talked about experience on title, and don't forget it's experience with flips and holds. So if you rehabbed it, it flipped it to a hold, that's still a flip. So when somebody asks you your experience, I had a guy once, he's like, I have 3. And I was like, cool. And then he sends me experience sheet, and there was like 11 on it. And I was like, you have 11, like, this is a different pricing bucket. And he's like, but those are all, I hold those still, I didn't flip them. But he did flip them, because he flipped them from junk to rehab into a long-term loan. So experience is both. And we talked about DSCR being an estimate. So IRA funds is a big thing that's going on right now, is everyone's tapping into the IRAs, which is an awesome thing. I had some headaches with these because not every IRA company is the same. Really get some background on who you're using, if other friends have used that company to actually do a deal, because they're all different. If it's a checkbook IRA versus not. Some that we had an incident with an IRA company where there was like 20 options of signers, but to go to underwriting, you have to have a signer for the IRA on the documents. And we couldn't find that because they don't assign it till the documents are there. It caused a whole stir. They now do it because they now realize what lenders need to kind of get those documents through. Long story short, it extended like 2 weeks to close because of how the IRA operated. And basically what the IRA funds is, there's no personal guarantor because the money isn't actually you. It is your IRA funds who's owned by the IRA. So there's a lot more stuff to that. So my only thing here is just vet the IRA company, because they all sound good until you get into the deal, and then you're just like, what? How does this work? LLCs is a big thing. It's a great way to protect yourself. Don't ask your lender how you should set it up, because everyone's different. Every state is different. Every idea that people go with sound good, and they all have a great pretense. But the one thing that we do know is it has to be in the same state. So if you have the LLC in California, if your property is in Ohio, you have to have an LLC in Ohio. Now, if you don't want to create a new LLC, you can do a foreign filing, but just know you have to do something. We can't close on an LLC in another state. So make sure, as you're expanding from where you live and where your LLCs are, if you're not creating new ones, look into what foreign filing takes. It's usually online. Some of them are really quick. Some take a little bit more time. So another big topic is adding second liens and PMLs and getting, using other people's money. It's a big one going on right now. there are creative ways to work with a PML and hard money. For our company and most hard money lenders, we don't allow seconds to be put onto our loans. We've done them before, but we just diligence up front. It has to make sense. And it's a situation where there's money there, it's just not being used. So we don't really generally like to lend if there's somebody coming with no money, no skin in the game. Like we definitely want there to be like risk on both sides of it, not just on the lender side. But there's lots of creative ways that they're doing it that are outside of putting a second lien on the actual property. So if that's an avenue you're going, I really think you diligence some of your groups of women that are already doing this kind of stuff and how they're doing it, how they're maneuvering it, because it's happening without putting a second on our loans. And then DSCR, a question I get all the time, and we're super popular for this, is we do 5+ units, and not every DSCR company does. So make sure you ask. I mean, the minute it becomes, you have that fourplex and you add the ADU, it's now multifamily, a whole new ball game. So make sure you know that your exit plan can support that for you. The last two things, seasoning funds. We don't season funds. So this is always with investing, you guys put money in different pockets all the time. This account for this LLC, this one for this one. We don't do what banks do. So when you move money, we don't ask you where did it come from, like show us the bank statements, nothing like that. You just have to close to escrow. The money has to come from the borrower, the LLC, the owner, the vesting. It has to all connect. It cannot be from some random account that you didn't tell us about. That might be yours, but it has to just come from you. But it's important that you know if your lender seasons funds, because some do, and then you have to spend all that time like backtracking, where did it come from and how did it get into your account? One thing I didn't talk about, I think I missed it, but seasoning requirements for DSCR is also something that you really want to ask about is, if I flip it, like how long do I have to hold it before I could cash out or before I can get all my costs back? So like us at 3 months, you can get 100% of your cost back, but at 6 months, you can actually get cash out on your value. So knowing the seasoning periods for DSCR is really important too. I think I missed that on my last slide. And the last thing, I get this question all the time, and I just always about being just, open about things, but people ask me, do we service or sell our loans? And the answer is yes. Like we're a lender and it's a part of kind of like the business. It's not a negative. I'm not sure why people think that. Servicing a loan is after we sell it. Like we have Conventus servicing group that services a lot of our loans, but we can't manage all of our loans. I'm sure Brenda told you, I think we close I think we're at like 7.4 billion right now, but we can't manage every loan in-house. So we definitely we have, I think it's Faye, we have other servicers that service our loans, FCI does. It's still our loan. Like when we do the payoffs, we still reach out, like we still are a part of it, but we just can't handle all the servicing. But it's not a negative. Some servicers we've walked away from because they're not as great as others, but it doesn't mean like your loan sucked, so we sold it or we got rid of it. It's just a matter of it was one that fit the box to move to another servicer. I don't see it as a negative. And again, I'm an investor. I own my own properties, my personal residence. Like my personal home has had 10 different servicers over the last 10 years. Like it's just a part of the game. And then if selling loans, it's kind of how this works. Like down the road, your loans get sold, they get, packaged up, the market buys stuff. Like it's just kind of a part of how a lender makes money on top of doing loans. It's not a negative again. Actually, to sell a loan, you have to have a really good product and a really good loan, good borrower, good everything to that. So again, these are two things that are not negatives, but I guess I more just want people to be like less scared of that. It's okay if a lender sells the loans. It's okay if they have another servicer, unless they're Shell Point. Shell Point's rough. But yeah, so that's kind of, those are the needs to know that I feel like I wish every borrower could just know before they walk into a lender and kind of understand what to ask. And then if Brenda, you want to go to the next one?
I also want to add a point on that. So
Yeah.
why some people might get worried is that they might think the lender won't have control over the loan. And so you definitely want to vet your lenders and, ask them, how much have you funded? like how many years have you been in business? Do you have testimonials? Because the reason we have good testimonials is that we are very hands-on with our borrowers even after they close the loan. And so we're there to help them, talk to the servicers. We have an in-house servicing team to manage the communications. We try to get discounts on their extension fees, on any late fees, if it's reasonable. So definitely make sure your lender's on your side and they're not just selling your loans and saying, oh, I don't have anything to do with it. It really depends on the shop there. Yeah.
That's true. That's true.
Okay, that's great. So we're getting asked about contacting you guys, getting connected to you both. So yeah, that'd be awesome if you can do that, get the QR code and all.
If you guys do the QR code, you'll be asked to enter information and you just get added to our list about that we saw you on this promo or on this webinar. And then one of us will reach out to you, and we both work with teams. So initially, like Brenda and I will probably reach out, and then you'll work with Mary, or Brenda works a lot with Sophie. And but if you guys want anything, so if you want the slides, if you want any of the checklists we talked about, and I don't know, I know we want to stay here, but I did have like a picture of the PFS in here too. So if you want a copy of that, and then we both just do consultation. Like, we're busy, everyone's busy. But that's what's fun, is like hearing about the deals. So I always get a call and they say like, I don't want to bother you, but I'm like, but I want you to. Like, I want to do your deal. I want to hear about it. And if I can't help you, I want to get you in the right direction. So please reach out to us.
Awesome. Love it. You're getting my wheels turning. I definitely need to speak to you, Melissa, about this other deal that I'm working on myself, selfishly. But let's get to some questions, because I have a bunch, but I don't want to take all the time here. Kwanzaa, I love your energy. You asked about 7 questions. I love it. I don't know if we can answer all your 7 questions, but I'm going to answer a few. So I really appreciate you and appreciate what you're asking. Let's go with this question. Who would want to get? So I think it was earlier and this is a really good point. This is earlier in the presentation. You guys were talking about verifying the contractor, right? I think it was you, Kwanzaa, about not just verifying the contractor, but verifying what the contractor's saying in terms of length of time. As a real estate investor, there's 2 things you're managing: timeline and the money, right? The budget and the team, obviously, those 3 pieces of the puzzle. So, you need to verify with the contractor. You're going to do that in a lot of different ways. I know you're asking a little about like the CPA and a lawyer. You really need to study what project you're actually working on. So say you're flipping a property, what depends on what type of flip you're doing. I'm going to be bringing a property down to the foundation and rebuilding like a 3,400 square foot house. Very different than, improving the kitchens and bathrooms. 2 different projects, 2 different time frames, right? So I'd love for both of you to jump in, but you want to verify not just with the contractor, but like, what is the time frame for a project like that should be? And then there's gonna be a range, right? So the litmus test is that contractor off or on? The project I'm working on, I've had a contractor tell me 14 months. I had one contractor talk to me about 6 months, all over the place. It's probably going to be on my session is going to be about 9 months would be the goal. What I think is really where we're going to land. What do you both think about how do you verify timeline and budget? Because if you're putting the project together, those things are a huge deal, right?
Yeah. You want to go ahead, Brenda?
Sure. I would say it's really great to join investment groups and talk to other investors who have done that specific strategy in that specific city to see, whether that timeline is reasonable. And then contractors definitely see what projects they've done in the past. I've seen investors write in contracts like, this is how much per diem the contractor will have to pay if they're over, time, and then this is how much bonus they'll get for each day they're saving you. So there are ways to kind of write in the contract to make sure that they're, taking your project as a priority. And then, we also have an internal construction team that'll look over your budget to see if it's reasonable. And they've looked at thousands of projects. So that's another way to vet. And then the appraiser will also see if, the ARV makes sense, and they'll look at comps and things like that. If you have a very unique property, for example, some people are building ADUs and things like that. The appraiser might not have those comps, but so if you have comps that you want them to look at, definitely submit to your team. It's not always that, we can submit comps, but sometimes it's a discussion to be had with the appraiser. So yeah, but Melissa, do you have anything else to add?
Yeah, just to add, I mean, that's all great. And I totally agree with it. We can say what we want, but get it on paper, like find out what the penalty is if they're delayed, or what how much room do they have and what they quoted versus what costs are. Like can they just go over 30% and you're stuck paying that? Like find out what the fine writing is. If they quote 6 months, I tell people add 3 months. I mean, it's just the nature of construction, or what time frame, like what weather you're in and where you live. Depending on, like, winters somewhere, we're not doing construction. The other thing though too is find out their project load, because this is where I find that many of my clients are frustrated. Is like, well, he's at another project, and it's like, okay, we want them to be good so they have other business, but find out how big is their team. Is it just you and Joe, and you get here when you can, or do you have a whole team? And 25 projects is okay, or as if it's you and Joe and you have two, that makes more sense. So those are kind of the things I would say, like, on top of that.
Love that. And I also would just, just because it's literally top of mind, the contractor needs to have expertise, not just in like the type of property you're doing. That's obvious, right? If it's a flip or like a simple renovation, but the area itself, because we all know areas have nuances and the connection to the town and the zoning officer, like that matters. That's all time. I know a contractor where we were considering, and then the guy was so incredibly slow on the phone. I'm like, there's no way I can work with this man. He had no connection to the town. He had never worked with a town before. That matters, right? So remember, it's not just expertise in the asset class, it's expertise in the town itself, and having those connections and those relationships that it equals time. So remember that.
Yeah. Very good.
What is it? So a couple other things. This is a good question of like DSCR. When would these are all tools in the toolbox, right? And as investors, we want to really our goal is to become really good at knowing when do we use which tool for what product and what project. So DSCR, just like any other tools, are used. What type of projects would you say, Melissa, would be really good to use for that tool, the DSCR?
Yeah. So the two main type we do is the bridge. There's hard money is the bridge loan, which is the quick fix and flip short term, and then the DSCR is the long term hold. So this is going to be for your turnkey, your rent ready, renovations completed. This is like, I've done it, I'm holding it, I'm counting on this for retirement. This is going to be my long term hold. These can't be ones that you have a future plan for. So in the next year, if you're gonna drop ADUs on this thing, maybe not do a DSCR, maybe just do a bridge to hold yourself over and then get there, because they're going to have prepayment penalties, because we're giving you these low rates and the banks are counting on that at least the 5-year step down on those. And these can be like ugly grandma's house can be DSCR. It doesn't have to be sparkling perfect. If it's going to pass the appraisal and it has value to you for long-term, like that can be a DSCR loan. Just rent ready, turnkey, things that you've just renovated, no issues, can pass. Ground up construction can be DSCR. As soon as you get your certificate of your COO, so certificate of occupancy. Did I do that right? Okay. We use too many acronyms in this world, so I always have to be like, what does that actually mean? Once you get that can be a DSCR too.
And there's a few questions. If you guys could put your contact info up again, just as we wrap, because I want to be really mindful of time. This is a good question that we'll end on. How easy, Nika, hopefully I'm saying your name correctly, but thanks for the question. And thanks for everyone being on. And as we wrap, I'm going to ask you all to share in the chat box one thing you learned today. And, one thing you're going to use in your investing business. That's really important, to take one thing and to start implementing it. Take one action, even if that means contacting Melissa and Brenda. That's a positive step forward. And Nika is asking, how easy is it to get pre-approved to allow one to make a quick offer? So what does that process look like? Does it really vary, obviously, how prepared they are? I mean, I have a personal financial statement, right? I have one ready to roll. Everyone should have that ready to go, versus like, oh, because then you want to have as much stuff organized so you know what people are going to ask for before they ask for it, right? So, but depending on how organized somebody is with what they have in terms of their own, their net worth and their liquidity and all the things that are important, what's that time frame in terms of pre-approval?
Yeah, so we want to make things easy for investors. So it's typically just a conversation, like a call. It doesn't take too much time. So we want to understand, what's your estimated FICO score? How much reserves do you have? What market are you interested in, like city and state? And what kind of asset are you interested in? And what's your general business plan? You don't have to do the specific plan that you told us about, but that's just for us to see, is this a loan that we can even do? And so, are you paying the down payment yourself, or how is that being funded? So those general questions, and it's only after you get a property under contract that we'll vet, your entire business plan, we'll pull your credit score and do all of that. But like Melissa said, we don't need to take any fees for that. We don't need to actually pull your credit. We could do a soft pull if you want. Just so it's more accurate, but it's not needed. We trust our borrowers, so as long as we can verify that during the loan process, once you have a property under contract, that's fine. And yeah, we don't want to hold up any deals, and we know that sometimes it takes a lot of offers to get one under contract. So we sometimes even give a template as long as they stick to the general plan that they told us about.
Great. Yeah, I mean, I will reiterate this. Lenders are, and I know both of you, what you bring to the table, it's not just lending options. It's holistic. And I think that's the other part of the puzzle, is that I've learned different things from lenders of what projects are, how people are mitigating, the market right now, right? Because you're talking to borrowers, you have so many different customers. So again, think of lenders not just singular, right? There's a holistic approach here. And I think what you both bring to the table shows that, and how committed you are to the community and all that good stuff. So thank you so much, both of you, today, for sharing your knowledge and really how to set yourself up for success when it comes to financing. So good actions, great info today. Thank you. Good stuff. They're going to be reaching out. Kelly, I'll be reaching out to Brenda, Melissa. Any other actions, please put in the chat box. Do something with what you learn. That's why we do this. That's why this is live. That's why the three of us are on today. Take a step forward, take action. I've already texted you, Melissa, so I can set up a call with you.
Okay. I know, I want to hear an update.
That's my action, but seriously, do something with what you learned today. Thank you so much for being on. Brenda, Melissa, as always, thank you so much for all the support. And
absolutely,
do something with what you learned today, everybody.
Yes. We look forward to talking to you guys. Reach out, and Brenda and I will take, hopefully there's a rush, so we have to we'll handle them as we get them, but we're excited. We love Investor. Brenda's SoCal, I'm Seattle, but we're everywhere, and we'll be in Orlando this year.
Yes. Less than 6 months. Get ready. I'm ready. I'm ready for
ready
the warmth.
I know, 40 degrees. I'm ready.
Yeah.
Okay.
Like 20. All right, everybody. Take care.
Thank you. Bye.
Bye.